Welcome to This Explainer. Today, we're unpacking a massive financial trap that literally catches up to 70% of new business owners completely off guard. We're looking at the story of Maya. Maya runs a booming, highly successful digital marketing agency. Everything is going great until she goes on a recent software shopping spree. What she doesn't realize is that this spree is about to trigger a massive tax time trap that threatens to derail her entire financial reporting system. Let's look at exactly what happened and how you can avoid it.
So, to keep her agency running smoothly, Maya picked up some standard everyday tools. You know the ones. She grabbed a $30 monthly subscription to QuickBooks to handle her invoicing, and she signed up for Canva Pro for her team's design needs. Pretty standard, right? We all use them. But she didn't stop there. Maya also made one major, permanent software purchase to manage her growing roster of clients.
That massive purchase? A staggering $10,000. She spent this outright on a custom-built database system. Now, this wasn't just a quick app download. This was a robust piece of architecture designed specifically to last her agency for the next 5 years. It's a huge investment in her company's future infrastructure.
So, here is the crucial point we're debating today. If Maya pays monthly for some SaaS tools like QuickBooks and Canva and pays just once for a massive custom database, should both simply be written off as regular business expenses today? When tax time rolls around, Maya hits a literal wall of panic. Is all software created equal in the eyes of her ledger? Or did she just buy a long-term corporate asset? Let's figure this out.
Let's dive right into the first part of our debate, the SaaS confusion trap. This is a classic logical fallacy. Because we live in a world absolutely dominated by monthly subscriptions, Maya automatically assumes all software is handled the exact same way on her books. She thinks, hey, I bought a tool for my business, so it just goes straight into the software expense category. But look at the core contrast here. Your monthly SaaS tools are consumed instantly. As you pay for them month to month, you use them, making them a true recurring operating expense. But that $10,000 custom database, Maya owns it outright, and it's going to provide ongoing economic value for half a decade. They are fundamentally different things.
And that brings us to the balance sheet destruction, a truly fatal bookkeeping error.
Because Maya assumes everything is just a regular operating expense, she records that entire $10,000 database purchase on this current month's income statement. And guys, that leads to absolute financial destruction on paper. By expensing the entire 10 grand all at once, she completely annihilates her profit margins for the month. Literally, her profits just vanish. If you're trying to secure a loan or, say, bring on a partner today, this massive negative drop makes her thriving agency look absolutely broke and completely toxic to investors.
Fortunately, before she actually sends these disastrous reports out, her accountant steps in with a serious reality check. He looks at the numbers and basically says, Maya made a classic rookie mistake. He explains that confusing these two totally different types of software purchases isn't just a minor filing error. It is actively destroying her financial reports and hiding the true profitability of her business.
This gets right to the core of the accounting debate: expense versus intangible asset. It really all comes down to recognizing exactly when a software purchase graduates from being a run-of-the-mill expense into a permanent corporate asset. It's all about how long that software actually provides value to the business. The accountant explains that expensive, permanent software licenses are simply not expenses. They are what we call intangible assets, meaning they're non-physical permanent assets. Because Maya owns this database outright and it's going to benefit her for years, it belongs squarely on her balance sheet, not hiding out on her monthly income statement, ruining her profit margins.
So let's look at the amortization fix. We know the problem, we know the rule, but how do we actually fix the math and restore her profitability?
The answer is amortization. Instead of taking a giant $10,000 profit hit on day one, the accountant teaches Maya to use amortization to safely and accurately distribute that heavy cost. Basically, amortization is simply the process of capitalizing a software asset and spreading its costs smoothly across its actual useful life.
By capitalizing the software, that $10,000 cost is logically and smoothly spread across the database's 5-year useful life. That means she only recognizes $2,000 a year in cost. This completely eliminates that single-month profit drop. It actually reflects the reality of the business, which is that she's using a fraction of the database's value each and every year.
So, to quickly recap the accountant's fix. Step 1. Capitalize the software asset. Step 2. Move that $10,000 out of monthly expenses and right onto the balance sheet. And Step 3. Amortize it over 5 years.
By following these exact steps, Maya's monthly profit report immediately bounces back to looking incredibly healthy, highly accurate, and most importantly, it reflects the true booming nature of her agency.
If you want to avoid making this exact same financial mistake with your own business tools, there is definitely help available. Visit Finance Made Simple at the Blogspot link in the description below this explainer. There, you can read the complete, step-by-step written breakdown of this process. And while you're there, you can actually download your free small business bookkeeping starter pack templates entirely for free. Before we wrap up this explainer, I really want you to look at your own books and ask yourself this critical question. What hidden assets are destroying your balance sheet right now because you accidentally categorize them as a monthly expense? Take a look, make the fix, and please don't forget to subscribe for more financial lessons just like this one. See you next time.